All right, and we should be live. Welcome to Thoughtful Money, folks. I'm Thoughtful Money founder and your host, Adam Taggart. Welcome you here for a special Sunday live cast with Thoughtful Money's endorsed precious metals provider, Andy Schectman, the CEO of Miles Franklin. Andy, how are you, my friend?
Adam, Happy New Year, brother. Good to be here. Sorry I'm not in the studio today. I've got a house full. I got two of my three kids here, and each one of them has two or three friends here. So I still have a house full of kids, and one more day left before everyone heads out. So I figured I'd do it from home here today.
No, it's quite all right, and that's the best part of life is when you still have a lot of life in the household like that. So enjoy it. And
yeah, it is.
You.
It's you miss them like heck when they're not here. Then when they're here, you love them. But it's like, is it time to get out of here yet? Well, not there yet. Almost.
So this new neighborhood I live in has older folks in it, and so a lot of their adult children visited for the holidays, and that seems to be the whole story on the block. Great to have him here, but man, couldn't wait for him to leave.
Yeah.
Well, anyways,
no, it's a blessing.
But thank you for making time for our audience in the midst of all that. Everybody else watching, Happy New Year to you all. I see folks watching already from around the world, Norway, a few other countries here. A couple of things just before we get started and get to the central question of today's discussion with Andy, which is going to be, after hitting something like $83 an ounce a week ago in the futures market, silver corrected, by about 15%. It's last count had risen a bit above that. But the big question on everyone's mind right now in the silver space is, did silver just peak? And so Andy and I are going to talk about that in just a second. Real quick, a couple of things. One, I'm noticing my face here on the camera, and folks, you might see some darker spots on my face. Reason for that is I had my first dermatological, full skin scan in years, and actually it went quite well. But they did find a couple of spots on my face they wanted to blast with the cold freeze to clear up. So, anyways, I didn't get in a fight.
Well, just as an aside, that's not what this is about, but I'm going to mention it just because.
Go for it.
I live down here in Florida, and I've always been fairly olive skinned, dark complected. I don't need to go. I said to my wife, I don't need to go. Come on, you're going. So fine. I go to the dermatologist with her, and the dermatologist, you're in your underwear, basically. It's a 2-second thing. They did, and she's like, you're perfect. Wait. She says, you got this little tiny thing that I don't really love, and it's on the back of your shoulder. Now, if you're living by yourself, you're not doing something like this, you're never going to catch it. And they test it. Comes back stage 4, highest level of abnormality before it becomes cancer.
Whoa.
And she said, it's got to go. Well, it did, and then it's gone. But, the point of it is that I play a lot of golf, but I'm not walking around here sun tanning. So it's not even that this is getting an inordinate amount of sunlight on my shoulder blade. Get tested, man. I'm glad you said it, and you never know. Maybe just one person hearing this will say, fine, I'll go get tested. It takes 5 minutes and it can save your life. So just thought I'd say that.
I very much appreciate you sharing your own personal story there. So Andy, you probably don't know this, but on this channel recently, I've mentioned that since I moved to Nevada, I've ended up getting a concierge medical doctor, which is great. And I won't go into depth about it because I have before, but it's actually not even that expensive. And what he's doing with me right now is just going through the list of things that could kill a man in his mid-50s. And now we're down to the skin cancer part of it. And what's great about it is one, someone's there looking at you. A lot of this stuff is diagnostic. As you said, it doesn't really take that long. And oftentimes these tests don't really even cost that much. But we've already ruled out a lot of heart conditions. We've ruled out a lot of different types of cancer. We just ruled out the skin cancer thing. I'm not looking forward to it, but I've got my first colonoscopy ever coming up. But basically it's like the diagnostics on a car. And then once we have a baseline, then we kind of know what to treat or what just to focus on preventatively. Unfortunately, in my case, knock on wood, the results have been coming back largely negative, and I hope to keep it that way. But I got to tell you, the peace of mind of just knowing this, at my age, and I'm going forward in the next couple of decades of my life with pretty good baseline, even just the peace of mind alone has a lot of value. But of course, if I'm catching anything, That's really important. And my wife is sort of like you, Andy. She takes great care of her skin. She's already had 2 melanomas removed from her, which anyone who knows that procedure, it's not all that fun. I mean, they really take a big divot out of your back or your body, wherever they find it. It's kind of ironic that despite these little spots that they went after, I asked her for like, well, what's my letter grade here for, guy in his mid-50s? And she's like, oh, A, you're doing great. And the irony is like, I don't use nearly enough sun. I don't wear sunscreen that often. I should wear it a lot more. I should take much better care of my skin. My wife, who's been doing it for decades, is the one who actually hit the melanomas. So sometimes it's there's no rhyme or reason to it. A guy who probably should get it, like me, who's fair skinned and doesn't take great care of his skin, should get it. Thankfully, I don't have it. But to your point, an olive skin guy who wears shirts out in the sun still found he had an issue. So to your point,
where the shirt covers, not my arms, not my face, not my ears. Yeah.
So there's no real rhyme or reason for folks, to Andy's point, go get tested. All right.
Yeah.
Sorry, folks, didn't mean to turn this into a total skin cancer public service announcement, but whatever. Okay, we're going to get to the question in just a second. I also just want to note, Andy, I had a really interesting experience the other day. I got to be a little coy about when and where I did this, but I got to spend time with a collector of not just precious metals, but some other very rare minerals. Super interesting experience. I hope to be able to talk about in more detail. But at the meeting, he introduced me to a mining CEO, precious metals mining CEO and geologist. So of course, we spent a lot of time talking about what's going on with silver and what's going on with precious metals in general. And the mining CEO has been in the business for decades. Said, hey, I don't know where silver's ceiling is, but he said I'm pretty positive that it's got a new floor of at least $50 from here. So even people in the industry are, who have been tracking these prices for decades as part of their career of pulling it out of the ground, are basically saying, what this metal was just structurally underpriced by the market, and that is being corrected now. Now, in terms of how high it can go, he had no idea. This guy also spent a lot of time talking to Eric Sprott, who I'm sure you're familiar with, Andy, and just sort of channeling Eric. Eric is a lot more bullish than he is. He's kind of in your camp, Andy, thinking, hey, this train ends with certainly triple-digit silver, and before the party ends, we could see 200 at some point in there. So anyways, just wanted to share some very recent industry insight that I got here. But to the key point of this discussion here, do you think, let me put it this way, has silver peaked? Did we see the blow off top? Maybe we're going to find some new baseline. Maybe it's 50, maybe it's 60, maybe it's 70. But we're not going to get into triple digits anytime soon. That is the question on people's minds right now. Do you have a strong opinion one way or the other?
I would say to you, we have not come anywhere near peaking. It could be a short-term peak. Look, we've had, within 2 weeks, we've had 2 big margin increases. Now let's talk about what that is first and foremost. The margin increases, especially coming in thin holiday trading, which would amplify it more than anything, is designed, in my mind, to flush the weak hands out. What's more startling to me, and I'll come back to this in a second, is the amount of deliveries that we're seeing, which we're going to talk about. I had lunch the other day with, geez, I don't think there's any problem with me saying this. I had lunch with the owner of the New York Mets the other day, Stevie Cohen, who's a big hedge fund guy. And I went to his house for lunch. He lives very close to me, and interesting man, phenomenally interesting man. We talked baseball the whole time. We talked baseball cards, my baseball cards. We talked baseball cards for an hour. We didn't really talk about economics. The reason I bring it up is he lives in the neighborhood. Mark Wahlberg is his neighbor. Alicia Keys down the street. These houses are $35 to $50 million. Do you think they care what the mortgage rates are? These people come in there and pay cash. Now, what I'm saying is that what the CME did is what they always do by raising margins on December 31st by 30%, and a few weeks earlier by 10 or 15%. It flushes out the weak hands who come in on margin, who wanted to capitalize on a silver market that's moving parabolic. Now, this is easy pickings for the big banks. Forget about the major trend. It has nothing to do with the trend. This is I'm going to scalp you because you think you're smarter than the market is and you're not big enough to play in this sandbox. So here's what we do. All of you who went on margin to buy more silver at leveraged silver in order to make money, we're jacking up the fee, the margin that you have to have within your account. And so we're going to jack it up to a level by where it's going to put some severe pain on your pocketbook. And if you don't pay that margin, if you don't do that right away, why then you are going to have your position liquidated, which happened. And let me see how many. The first time they did it, the amount of, so we saw 13,430 contracts sold in 15 minutes. That was the first one on December 12th.
Wow.
The 26th, they followed up with the second increase. Sorry, I thought it was the December 26th, day after Christmas. And they rose the margin up to $25,000, a $3,000 increase. But you saw huge, in other words, you have to have $25,000 to own a contract in your margin account. And so what happened was all of these contracts got liquidated. Well, who do you think came in there and bought it all? Well, the banks just come in and buy it all, scoop it up on the cheap. It's called shaking the bushes. And it was done magnificently. You could argue that this was textbook. The speculators who come late, who think they're smart, who come in unleveraged, the big houses just shake the bushes real quick, and out comes all of the silver that they get to pick up on the cheap. I don't think it's the top at all. I look instead at one of the biggest anomalies that anyone has ever seen. Let's talk about Christmas. The total COMEX delivery notices as of December 26th, or in fact, the end of December, 62,875,000 ounces, record high for December of all time. Now ask yourself, who's taking possession of 62,875,000 ounces? We can look at the January 5th delivery report where Deutsche Bank, now there's a rumor out there that the European banks are in hot water. Mm-hmm. And I talked with you about this.
Sorry to interject, but you've told us in previous appearances that you believe the U.S. banks, especially the J.P. Morgans, have flipped from being net short to net long, and the ones that are still sort of stuck long were the European banks. So this
well, that's what the Economic Times said. Now, that was an article, and it's interesting. One of your subscribers, one of your followers sent me an email, said, I can't find it. So he and I go back and forth, and if you put it into ChatGPT or one of the search engines, it says, yes, indeed, this article is real. This article was published. You go to the Economic Times site, it was pulled. It says this is no longer here.
Oh, wow,
interestingly really? Enough. But one of your subscribers and I had a nice conversation back and forth about this, and we validated that it was there, that what I read and what other people talked about was real, and then they pulled it. Anyways, Deutsche Bank on January 5th issued, in other words, they delivered 3.27 million ounces. And who are the buyers? J.P. Morgan and Citigroup. They are the largest derivatives holders on the market. Now, when I say J.P. Morgan has flipped, according to the Economic Times, that doesn't mean that they don't have short contracts. They do. It just means that they're net long and exposure to more long than short. Mm-hmm. Which is a big rarity. But the bottom line with all of this is that the deliveries coming by the most sophisticated, well-funded traders in the world who are not using leverage, that is more important than anything. Yes, you can talk about the fact that it has been classified a critical mineral. Huge. You can talk about the fact that the European Union did it at the end of 23. Huge. You can talk about the Chinese export restrictions. Huge. But when the most well-informed traders in the United States are standing for millions and millions and millions and millions and millions of ounces of silver every single month for going on 15 months now, that tells me that we are nowhere near the top. But you have end of quarter, end of month, end of year, selling, balancing books, taking profits. There's something on COMEX that is called Section 1256. Most people haven't heard of it. It basically says if you trade gold or silver futures on a registered exchange like COMEX, that you, no matter how long you hold the trade, it could be a day, it could be a week, it could be minutes or hours. When you sell it, the IRS automatically treats 60% of the gain as long-term, 40% as short-term. And that's a very big deal for active traders, of course. And of course, at the end of the year, the IRS also assumes that all open futures positions are marked to market. So there's a lot of, they can sell it, book it, buy it right back, and it doesn't trigger the wash rule. 30-day wash rule is something in securities that says if you sell a security for a gain, you can't buy it or anything else like it, or a loss, excuse me, more appropriately a loss. A very wealthy person sells a rental property for a big loss to offset a gain on Apple stock or something. You can't buy that or something similar back to it for 31 days. So in any case, all I'm simply saying is that there are a lot of things happening at the end of the year, whether it be shaking the bushes, huge deliveries, rules on COMEX that kind of make traders clean the books and then come back in. And then, of course, we have some other things that we'll get into about silver that I think are going to make this month incredibly volatile. The rebalancing of portfolios, where silver has gone up so high, it's now a disproportionate share of portfolios has to be rebalanced. At the same time, you got hedge funds, the January effect, they call it, coming in with all this cash. What are we going to buy? How about the best performing asset of 2025? Now that just got hammered down because of rebalancing, because of all of these things. No, the deliveries expose the rhetoric that these players who are standing for possession of billions every month are not doing this for the hell of it, Adam. It's just beginning. But to think it will be easy is fooling yourself. It will not be easy.
Okay. And by will not be easy, I'm presuming you more mean volatility, which is there's going to be a lot of shaking of the bushes here, and you want to hold on as best you can through it.
Right. The physical holding means nothing. I mean, there's no reason to sell your physical, not even close. But the paper price, which has a lot of speculators involved, playing against some of the biggest institutions in the world with unlimited checkbooks, they won't make it easy for those guys and gals to hang on. They're going to get shook, I think, extremely hard over the next couple of weeks into the end of January.
Okay. Couple of things. First off, Thomas Rediker here just reposted this stream. Again, folks, I keep forgetting to figure out how you can repost, but apparently you can. So if you're watching and you know how to repost this stream, please repost it like Thomas did. It just helps get more and more people watching this stream, especially while we're doing it live. Also, something else that we should have mentioned right off the bat, which I apologize for forgetting to do, is Andy, you have been very kind in offering to this audience the exclusive offer of being able to purchase junk silver from Miles Franklin for $1 under spot, great pricing, while supplies last. And just heard from you before we hopped on here that supplies have now been consumed of being able to get junk silver at that price. That said, you're still able to offer it at a very attractive price. And again, this is all being influenced by not just people taking advantage of the offer, but by the margin hikes that you just discussed. So what is the current offer for viewers here that would still like
to and I'm going to also explain how I was able to do that. Let me tell you real quick what it will be. Again, and it's very fluid. That's what I want people to understand, that it's very, very fluid. I can do it for your subscribers for $1.49 over the price of silver. It's nowhere near what it was. But it's still pretty darn good. In fact, you know what? Let's call it $1.35 for right now until I can change. Now, let me tell you why I was able to do that for a very long time. And I went around for the last several months buying everything I could find in pre-65 silver. We have a network of a lot of, small and mid-sized coin shops around the country that will sell to us because they don't hedge their position, and we'll take it when someone comes in. But here's what's happened. So you have a network of traders around the country, or dealers, thousands of small dealers, coin shops, pawn shops, all that stuff. And they will take in pre-65 silver. And let's just say for a period of time, there was more selling in the public than buying. And I've talked a lot about how premiums were low, making it advantageous for people who were able to take advantage of these low premiums. And this has been going on for a while now. So the dealers who aren't sophisticated like the bigger companies, and I say that from a standpoint of business operations, not their intellect, but being able to hedge. So if I have 3 million ounces of silver in my warehouse, like I will quite often, I'll hedge it. I'll sell short 3 million on paper. So if silver, I have 3 million ounces and it drops by $10, I'm down $30 million. I'm screwed. But it goes up on exactly the same amount on what I sold short on COMEX. It allows me to be market neutral. That is what COMEX was designed for. Okay, so imagine you have all of these dealers who don't hedge and they don't have anyone buying it. So what do? Every week they will go to their local refiner and sell it to the refiner, who will melt it down into bars. And the refiners have been loaded up on bars and on candlesticks and on jewelry and on all sorts of stuff, plus demand to make bars and rounds, right? So even the decent size refiners, the big ones, they're getting loaded up on metal to make bars and rounds, even if they're taking in 1,000-ounce bars to do it, right? So let's say they have 50 million bucks in their warehouse. Now, when I use COMEX, I'm selling through my inventory, bang, 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 and replenishing. So I'm constantly getting money to cover my positions and to do all the things that you need to do to make this work. A refiner, on the other hand, takes all this stuff in, has to melt it down, pull out the impurities, turn it into what's called shot, they're little BBs, ball bearing size things that they can then melt down and turn into bars and rounds. Now, this whole process, especially when they're continually getting stuff in, could take weeks, 4, 5, 6 weeks of various stages of production. And they're hedged. They have to hedge that silver that they took in, they paid for from the public. So they got millions and millions and millions of silver inside the various stages of production that they hedged. But what's happening? Silver has been moving up so fast, and they're not pulling this stuff out or making the refined product fast enough. They're getting margin called. And they're like, oh my gosh, silver's going up. Our short position's getting margin called, just like these traders are. Pony up the money or your position gets liquidated. So they stopped taking new silver orders or refining orders weeks ago. And so this silver, months ago, this silver just sat there, where now the big houses are saying, fine, I'll pay you, $1.50, $2 back a spot in order to take it off your hands. And that's how it went. I went everywhere and bought all I could. And now you're starting to see it reverse again, because the demand always will catch up with these imbalances in supply. That's where we are now. So the premiums are coming back up. How long it stays here for, I don't know. But remember, during the pandemic, for 4 years, I would have paid you between $8 and $11 over spot for as much of this stuff as you would sell me. Just like markets move too far to one side and they swing back too far to the other side, we got to kind of find that equilibrium in a market like this. Who knows when or where that will be.
That's super fascinating to understand how the industry works like that. So, Andy, you were saying previously that you'd rarely, if never, seen the pendulum swing that far to the cheap side for junk silver, correct?
Yeah, and I never saw it swing that far to the expensive side for junk silver during the pandemic for 4 years. So yes, to be able to buy something below spot is ridiculous. Very, very early on in my career, I can remember in the 90s when silver was $4. Yeah, I might buy it at 10 cents back a spot, something like that, and sell it for 30 cents over spot or whatever the number was, but never to be able to buy it in dollars behind spot. Never. And to me, that was just silly to not. I literally told my operations, I don't care if you have to go on our line of credit, buy every single ounce you can find anywhere. Buy it all. Go to all the big houses, all the big primary distributors, buy everything, buy it all. There's no downside. We can melt it down if we have to. We have that capability in our warehouse. We have a smelter. We can melt it down and
that's cool.
Send it to the Royal Canadian Mint for pool credit. Whatever we want to do, we can do with that, but there's no downside. And I think that's what you're seeing right now. As the reason the premiums rise, it's what it costs to get it after you sell it. So if we sell out of this, how much does it cost me to find it and get it now? It cost me over $1 plus more than it did for the last 3 months on premium. And I think that will continue to move forward as these kind of values don't come by, but once every so very, very frequently.
Okay. Well, kudos for having the foresight to do that. Again, thank you for making the great deal you were getting available to this audience with letting them buy it for $1.
They'll say $1.35 over for now until that changes.
Okay. So folks, if you want to take advantage of that, same URL as before, thoughtfulmoney.com/buy-gold. There's a super short form there. You fill it out. It goes to Andy and his team, and they'll be in touch with you right away. Obviously, if you want to, if you've got other questions about precious metals or other buying needs or questions, they're happy to help you with that as well. And Andy, I'm just curious, given the current market dynamics, that $1.35 over spot that you're offering, that's still, in your opinion, pretty good relative to
ridiculously good compared to everything else. Everything. Okay. You look at silver bars, most companies are out of stock of them. Why? Because of tariffs. No one imported them. The majority of them come from Switzerland, Valcambi, PAMP, metallurgia, something, I forgot the name of it. Doesn't matter. There are 4 or 5 very large refiners in Switzerland, PAMP, Valcambi, Argo Harris. There are a few others. And then, of course, the Royal Canadian Mint. And for quite some time, no one imported them because the threat of tariffs. And so bars, which are normally really cheap, aren't really cheap anymore and are hard to come by and are largely out of stock. And so, yes, when you look at the difference between junk silver and the next cheapest thing, which might be a silver round, it's still an amazing deal. It's by far the best value in the industry right now. Okay.
All right. Couple questions. One, for junk silver, as prices get higher, silver kind of comes out of the woodwork. The grandma's silverware, the tea set, the candlesticks, but also junk silver, right? And it gets sent to the refiners. Now, there's technically a finite amount of junk silver in the world. Over time, years, maybe decades, should you expect kind of the premiums on junk silver to go up simply because it's becoming a scarcer and scarcer thing to find?
Yeah, I would think so. And because it can't be reproduced. I mean, you're talking, it's a minimum of 59 years old. And is that right? 60 plus years old. Yeah, I mean, minimum. And so, yeah, you're talking something that has scarcity built into it just because it can't be reproduced. Some of it gets melted down. Yes, I would think so. I mean, look, when you talk about the amount of investable silver, there's a very small amount of it available. And people in this industry think very much like, well, it's I can still buy it. The online, it's plentiful. That's BS. It's not. There's so much money out there that is wrapped up in traditional forms of investment. If 1% of it leaves those traditional forms and comes into this industry, overnight it will overwhelm the industry. There will be nothing left. Nothing. And I do believe that. And what's really different now is you're beginning to see silver and gold take a different view globally as something that is probably worth more than the dollars and the currencies that are used to purchase them. It is a race. This isn't about 2 or 3 brothers trying to corner the market in 1980. This is the realization, I think, that by sovereign nations that gold and silver are vital in every way to a thriving economy. Gold will be tied to the monetary system because the system has lost all trust. It will marry, I believe, to blockchain technology. And silver, the reason, I think when you think about silver, think of it this way. Why? This is the only question. Why have 8 banks in the West? 5 in the United States, 2 or 3 in Europe, and maybe 1 in Canada. Why have they controlled the largest concentrated short position of any of the 1,000 commodities traded on COMEX ever in the history of the COMEX? Why have these banks done this? Why? It's a tiny little market. The question isn't that they did it, it's why have they done it in silver? Unlike any other market traded in commodities, the largest concentrated short position in any commodity ever traded in the history of the COMEX has been in silver. The Western banks have had a vested interest in stepping on the price. It has never been allowed to find real price discovery. The nations in the global South understand this. That's why they have, the name of my podcast, Little by Little. They're smart. Everyone's, why don't they just buy it all? Because you cut off your nose immediately to spite your face and the whole thing blows up. But if you do it quietly, don't. Little by little by little by little, stand for delivery all over the world. Don't tell anyone about it. You're China. You go to Latin America and buy all the Doré and the concentrate. Don't tell anybody. You continue to do this and doing it in the Globex market, which gives you access to the COMEX through sovereign wealth funds, through proxy banks. So it's not the PBOC doing it. If the People's Liberation Army accumulates it through a fund, that's not reported. All of these things are being done covertly and quietly, and it's finally starting to come to the surface. And you get the U.S. say, well, it's a strategic mineral. And China's saying, that's right, and we're not going to export any anymore through massive restrictions. Some will come out, but not much. What we are seeing I believe, is a transformation back to, they say history doesn't repeat, but it sure rhymes. Gold and silver have been money and part of the monetary ecosystem for 6,000 years. It's coming back into play. And I think that when you look at silver from that perspective, the price doesn't matter today, but the big money that's involved in it, they're going to do everything they can to make you think, why am I holding this? It's too scary. It's over. The top is in. The mainstream media will do that. They've done it the whole way, and they've never been right. And all of a sudden, what do you know? Here it is at $70. Yes, it's going to be volatile. But in the end, I think it is nowhere near its final chapter is where this ultimately goes.
Okay, good. And I'm going to keep chipping away at that in the remaining time we have. A couple quick things. And one, just to finish the point, I'm not trying to push this. I'm just trying to see if my brain is actually thinking correctly here. But, junk silver, it's called junk silver, referred to as junk silver because it is kind of the cheapest, easiest way to buy silver right now. But it might over time become scarce enough that it is no longer the cheapest way to buy silver because these coins just go away because they're getting, a certain amount of them are getting melted down every month. Again, if you're sort of playing a long game and just trying to accumulate ounces from here, this may be a good way to buy low and then have the appreciation of the scarcity be a tailwind to your holdings over time. Again, not going to happen tomorrow, not going to happen next year, but maybe over the next 5, 10, 15, 20 years, all of a sudden junk silver is like, oh, I'm going to pay more for that because there's less of it around.
It's as disrespectful as calling someone born with red hair into a second marriage stepchild, a redheaded stepchild. It's just as disrespectful. It's wrong. It's not junk. It's just pre-65 constitutional silver. The reason it used to be called that, I started doing this, silver was $3 and $4 an ounce, and no one wanted it in the 90s, right? And so it meant that it had no premium. Yeah, I could buy it at 10 cents back a spot back then, maybe something like that, barely back a spot. But it just meant that it had no premium, and it's a name that has, in the very woke world what we've lived in the last several years, that name wouldn't fly, right? It's very prejudiced to its real value, and it's not right.
It's microaggression. It's
that's what it is.
Misgendering, mislabeling silver.
That's what it is. In a funny sort of way, it's the exact same thing. It's not. It's constitutional silver that has 90% silver. Now, people never really understand what that means. It just means 90% of its weight. In $1,000 face value, if it were uncirculated, there would be 723 ounces of pure silver. But the industry will guarantee 715 ounces. In other words, they say up to 8 ounces could be worn off of 1,000 face through running through coin counters for 50, 60 years. It's actually probably almost exactly 720 ounces. But so, in other words, you take that and divide it out. A dollar's face is 0.715 guaranteed of pure silver, whether that be 10 dimes, 4 quarters, 2 half dollars, or 1 half dollar and 5 dimes, 2 quarters and 5 dimes, 2 quarters and a half dollar. Any way that you can make a dollar of pre-65 silver, anyway between dimes, quarters, and half dollars is 0.715 to 0.723 ounces of pure silver, period. And the 90% is just by weight because it was used as currency. The other 10% is alloy to give it strength so it doesn't get all goofy and bend and that kind of stuff.
Okay, so this just may be an inefficiency in the market here, folks,
Yes.
where it is just, sneered at a little bit more than it should be. And again, you're just going to have the mathematics of scarcity at your back over a long enough time frame here as more and more of this stuff goes out of the world because it gets melted down into a different form. Okay, so you were talking earlier too, little by little, kind of until the world wakes up and realizes this is a game of musical chairs, and then there's the scramble, and that's when things can go crazy in terms of silver price. That might be somewhat of what's going on here. Sounds like what you're saying, Andy, is probably to a certain extent, but you ain't seen nothing yet in terms of how crazy this could get. I do just want to reiterate the mining exec that I was having lunch with the other day. He was talking about the dynamics in the industry, and he was like, "Oh yeah, and well, I mean, now that Tether's in the space, and I mean, they're one of our backers now." He's like, a big part of running a mine in the past was securing the capital to actually continue exploration and develop the mine. So he had a lot of stories about mines that were selling for cheap because nobody had put any money in them for decades. And then once, a new CEO was able to raise enough capital, they could bring that mine back to life and realize a lot of value pretty quickly, right? He's now saying with Tether in the industry, man, you get Tether invested in your company. He's like, your capital raising needs done. Like it's a bottomless
Tether was
market.
at the Beaver Creek Mining Summit, which is the biggest mining summit in the country. We've talked about Bo Hines, who's the CEO of USA Tether, their new division, who was Trump's crypto czar. We've talked about what they will do with the interest on the stable coins. By January 1, 2027, we will all be moving money on the stablecoin network, a blockchain network backed by stable coins. Those stable coins then are backed by U.S. treasuries. The interest is not transferable. Tether keeps it. USA Tether will be the primary beneficiary of this. Tether already has over 14 billion in gold, more gold than anyone in the world except central banks. They're going to continue to buy gold and silver, which continues to devalue the dollar, continues to push these assets higher. These are all part and parcel, I think, of what they're trying to ultimately do. You're right. And you are beginning to see these kind of vehicles where it's not just the normal market dynamics. I think you can really see, and again, ask yourself, who's bringing in all this metal? As I mentioned, in December, there were 3.706 million ounces of gold that were delivered in December, plus 64.730 million troy ounces of silver. 64.730 million troy ounces of silver issued. But in the first 3 days of this new January contract, first 3 days, we've seen 4,249 gold contracts, 3,596 silver contracts. That's 424,900 ounces of gold, 17,980 ounces of silver come into COMEX in 3 days.
Wait. Now, 3 days of January is bigger for gold than the entire month of September? Did I take my notes right?
That was December. Okay. In December, there were 3.706 million troy ounces of gold in the whole month of December. In the first 3 delivery days of
January,
there was 424,900 ounces of gold.
Oh, okay.
So not yet.
Not yet.
And 18 million ounces of silver in 3 days. Now ask yourself, if a mint box of silver, which is 500 ounces, weighs 42 pounds, who's bringing in 18 million ounces of silver in 3 days?
Right.
But this is every single month. And to me, the biggest crime in all of this is, where is this moron Jim Cramer, and where are all these talking heads who are so intellectual and so invested in helping the public understand what's happening. Nobody is talking about this. I've been screaming about it. This is all you need to know, you guys. This is it. The most well-informed traders in the world here in the United States, you could argue that's Wall Street, are bringing in billions of dollars every month. Billions. I mean, in December, what is 3.706 million ounces of gold times 4,400? What's 3.7 million times 4,400? Your calculator will go nuts. What is it? It's into the billions. But this is every single month for 13 months now, since last November when he won the election. And that's all you need to know. The most well-funded and well-informed traders.
It's not just these big players that are buying, taking delivery and buying the minted ounces, right, or the smelted ounces or whatever you want to call them. It's also big players securing their ownership of the metal in the ground, right? That's what the Tethers of the world, now the Samsungs are starting to do, right? And so the point is you have kind of, almost almost price insensitive buyers entering the space now, because it's not about the price for them. It's about the actual supply of the metal itself. They need that. Well, some need it commercially, like Samsung does. And then others are aware of that and just saying, well, look, I want to stockpile as much of this as possible because the world is only going to want it more tomorrow than they want.
China's been doing it for 2 years. China's been buying silver and gold doré and concentrate for 2 years or longer, pre-production, pre-refining. It disintermediates the market. That's exactly what Tether is doing. They're disintermediating the market. My friend Keith Neumeyer told me a year ago, he said, maybe 2 years ago, he said that he was at a conference speaking, probably right as we were coming out of the pandemic, and saying, this is the first time I've ever seen auto manufacturers at the conferences I'm speaking at coming directly
for
to
folks who don't know, Keith Neumeyer is the CEO of First Majestic Silver, one of the largest pure play. Well, it's not quite a pure play, but one of the largest silver miners out there.
Yeah, as far in terms of pure silver, they are, I think, the purest of all of them. And that's only about 60% of what they do is silver. I'm pretty sure they are number one in terms of purest, which goes to show just how hard it is to mine silver these days. Of all of the 850 plus million ounces mined last year, only roughly 160, 70 million came from companies like Keith's. The majority of it, because it's depleting in nature, it's found up on top, like your skin is epidermis. It's found in something called epithermal near the top. So the big deposits are gone. It's mostly byproduct of copper, zinc, and lead, and they stumble across it. So it's becoming harder and harder and harder to find. But he said, yeah, they're coming right up to the conferences to disintermediate the entire marketplace. But that's what China's been doing. Sean Kuhn, who is the CEO of Dolly Varden, has told me this a year ago. Yeah, Andy, they're coming by the drove. They go to Mexico and Peru, number 1 and 3. China, number 2, largest producers of silver in the world. Buy the bars in doré form, buy the concentrate, a byproduct sludge, if you will, of the mining process, pay double what the West will, ship it back to China to refine it. It's the same thing that we see now happening. The big money is doing all they can, whether it be Tether or the Chinese or Samsung, and I'm sure there's a lot more that isn't getting publicity. They understand that this is a depleting asset, one that has, you need it, or you can't make your product, or you can't have an advanced civilization in AI, robotics, high-tech military, all of these things. And that's why Trump made it a critical mineral in my mind.
Okay, so a couple of recent geopolitical things to ask you about. One, China, one of the things people think that was driving the recent surge in silver was that China basically announced it was going to implement an export ban on refined silver. And I think you've told us in the past that China is the number 1 refiner of silver in the world. All that doré, everything goes to China, gets refined, gets shipped back out. China is now essentially slamming the window shut and saying, hey, any silver that comes in anymore is going to stay here, more or less. And I believe that export ban did indeed go into effect 2 days ago.
January
1st. Yeah. What are we seeing from that? Anything yet?
Well, I mean, we'll know more what's going to happen once the market opens up here in, let's see, what time is it? It opens up in 6 hours. We'll see what's happening. But I mean, I think, again, it just goes to show if you have nations that are saying, yeah, this is critical, and yeah, we agree, we're not going to send it out anywhere near like we used to. I mean, they will send some out, but they're the only, if you're not a state-sponsored refinery, you can't send it out anymore. And there were all these small mid-level refiners that would send all their stuff out. Not anymore. You have to have a certain amount, like you have to produce a certain amount, be proven for a couple of years, and then get a permit through Beijing. But the state doesn't want to send this stuff out. It's going to have an effect. They're responsible for 60 to 70% of all the world's silver refining, and a lot of that would make its way back into the Western markets. And so if there is hoarding here on COMEX, again, millions of ounces every month, millions of ounces. These people aren't letting it go. So once it comes into COMEX, where's it going? Who's standing for delivery? Who's taking it out of the COMEX? Yeah, it's a race, and it will. All of these things will add up. And the interesting thing about it is that people who listen to me and you and others in this industry, Vince Lancy, amazing, a lot of really smart, good guys out there that are telling us this, well, we're the pimple on the elephant's rear end. The big money, the rear end, they have no, or the elephant itself, rather, they have no idea what's coming. And that's the interesting thing, is that when you take a step back and realize big money always positions before the herd, well, you can see it. You guys have a front row seat to see it. What makes people who listen to you and others in this industry unique is they have open minds. But I guarantee you, a Christmas dinner or Thanksgiving dinner, they would have a very hard time speaking this way to their friends and their family because no one gets it yet. So you will see profound impacts. But by the time it's recognizable to the mainstream, it'll be far too late. Everyone will have been far too positioned. And what is left, the scraps, will be too far and too few between in order, I think, to make it realistic for those people to protect themselves, because it'll be too expensive, too hard to get, too long, too many delivery delays, etc. Public is just now starting to wake up. The retail business has picked up over the holidays. I wanted to take a vacation. I worked my ass off every single day. Our phones were blowing up, truthfully. And
with a lot of thoughtful money viewers, by the way, I just want to acknowledge that a lot of people have taken advantage of this opportunity you've made available to them.
Well, and I appreciate that. And I will tell you, there's some of the highest quality people that we've spoken to ever in terms of their intellect, their understanding, their questions, everything. It's been wonderful. And but I don't think that we've even begun to see where this is ultimately going to go. But I do believe that January in particular, they call it the January effect, where lots of money is being deployed. But because silver went so high, at the same time, the Bloomberg Commodity Index, they have to rebalance it. So some silver has to be sold by law, but that plays right into the hands of those that are coming in to buy it, plays right into the hands of the banks that want to scoop it up. It's going to be volatile. Don't get shook. It's going to be volatile, but come back and look at this mid-February, and I think things will start to make a good deal of sense.
All right. Well, Andy, we will continue to have you, return to this program with a regular cadence. Hopefully not for your schedule as much as I've been leaning on you of late.
No, I love coming on, and I'll always make time for you, Adam. I'm dead serious about that. One other thing I just want to hammer on for 1 second. When we see the institutions closest to the metal prioritizing control of deliverable silver, not promises of future availability. In other words, where JP Morgan and Citibank are the two biggest recipients of all of the silver that Deutsche Bank, they made Deutsche Bank give up. Now, normally metal would flow back and forth between the banks in Europe and the banks in the United States. Remember, Tom Luongo has this theory that Trump is out to get the European aristocrats, and he'll do it by exposing the European banks, including the Bank of England. Well, all of this metal is coming back. And when you see Deutsche Bank have to cough up all of this gold and all of this metal to, in particular, JP Morgan and Citibank, it's like they're cannibalizing each other, that this relationship, this unspoken relationship, is now breaking down. And I think that is a really, 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 really big deal. To to me, it's interesting because Citibank says it's for their house account. JP Morgan says it's for a client. Who's got that kind of metal?
Right.
Which clients want to take in this kind
who's
of
got
volume?
that kind of money? Yeah.
Yes. And so I just want you to understand that these banks never cannibalized each other. It seems like maybe, and they were either forced or willing to deliver to JP Morgan and Citibank. And the best way to say that is the smartest, best connected institutions in the silver market now want to hold the metal themselves right now rather than take the paper promises into the future. This has never happened to this degree. It just tells you that that's all you need to know going into this volatility. Hold tight, even shut off your darn computer, come back and look at it in February. You'll be probably better off.
Okay. So forewarned, folks, the roller coaster ride might get a little bumpy from here, but Andy's not, he's not worried. He thinks higher prices will be ahead once the dust settles.
Yes.
Okay, couple other things. So over the weekend, we've had the U.S. remove Nicolas Maduro from Venezuela, and Trump was pretty direct, saying, "Hey, big reason for this is they took, our oil infrastructure that we had in place down there, and we want it back." And obviously, Venezuela's, been a basket case in terms of oil production. They've got I do believe with oil, they've got the world's largest reserves, and yet they have done such a poor job of tapping them in recent decades because of the shortcomings of the type of regimes that have been running the country there. So obviously, big priority for Trump and America to say, okay, let's start getting that oil out of the ground better. Venezuela also holds a lot of other riches. They are one of the most rich countries in terms of gold reserves in the ground. Do you expect this over time to have any impact on gold and maybe silver as new supply comes into the market that hasn't been getting tapped over the past couple of decades? You're shaking your head. So, okay, let's
and they have other things, natural gas and all sorts of other things. But no, if silver's a strategic metal, if they get their hands on it, it ain't coming back. And you could say the same thing about Gaddafi, about Saddam Hussein. And what about the 12 billion in gold the Ukraine sold to fund the war? Where'd that go? You could say that's all perhaps coming back to the U.S. for strategic purposes. Yeah. And, when Trump starts talking about the Monroe Doctrine, I think he's saying it's not just, this is like a pushback to the BRICS in my mind. Venezuela had applied to the BRICS. It's not just about them. He came out, there's an article in Axios that says he just publicly issued warnings to governments of Mexico, Cuba, and Colombia.
It was pretty thinly veiled in his press conference that
yes.
they shouldn't rest easy. Yeah.
But I mean, I think that if they're going to come in and take this stuff, it's not going into the open market. It's going into the U.S. coffers, because I do think that is part of national security. Certainly silver is. And if Judy Shelton, who you and I have talked about a million times, is right, well, that's part and parcel of what Tether is doing to push the price up. You need lots of gold to back the treasuries. Well, that would make sense to me. It ain't going out into the marketplace. It's going to back a new system, I believe, a new monetary system. So yes, it will have impact in terms of how it would benefit the country that holds it, but I don't think that's going to be something that will be dumped onto the COMEX market or onto the LBMA for anyone who wants to buy it. No, it's just going to strengthen the position behind the scenes.
Okay. Good insight, and I'm just noticing comments. We get more comments than I expected in the live chat here about people saying, "Hey, thanks for sharing all that about the skin cancer stuff." So, fortunately, we've got some people that are going to go get tested, and we've got some people that actually
God bless
skin cancer survivors saying, "Hey, this is really important." All right, so let me ask you this, because you were talking about how by the time everybody kind of wakes up to this, the elephant the general public wakes up to the fact that, the silver stuff's a lot scarcer than we realized, and man, I want to get my hands on it now. And you think, it's going to be too late, more or less, by then. Back when gold was hitting its previous nominal high of 1900, so what, this was 2011. As it was racing there, there were cash for gold ads everywhere, right? Gold's back to it has recently hit an all-time high. It's a little off, but it got to all-time highs recently. Silver's going bananas. I haven't really seen those ads yet, and I'm curious when the silver gig is up, do you think we'll be seeing cash for silver ads everywhere?
You know, part of me believes that the majority of that stuff has already been sold along the way. And I say that to you from talking to people. Say, yeah, man, I sold that stuff a long time ago when it wasn't worth that much, and I dumped it. And maybe there just isn't as much of that out there anymore because, you know, people when gold hit 2000, I think people thought that's it, and it ain't ever going higher than that. Dump it now. And certainly when silver hit $50, it ain't ever going high now. Dump it. It's an interesting thought, but I haven't seen as much of it either. I don't know. I mean, I'll tell you that as someone who runs a precious metals company, we get very little in the way of people selling. Of course, we will always run a two-way market, but I would argue that the majority of that stuff that was in weak hands was sold a long time ago. Just my own personal opinion. But yeah, I mean, you should. Silver is becoming that valuable. You know, a tube of Silver Eagles, you know, something like this, it's 20 coins. It's not cheap anymore. It's, you know, it's $1,600. So it's not cheap. So yeah, I would think it should. And I'm sure you will see people that would be willing to and happy to buy people. So the only other thing too is that, you know, you can, if this were a tube of gold, it's $90,000. So when you talk about shipping large amounts of silver, it becomes a little bit more difficult and stuff. Yeah. But I mean, I don't know. Your question makes sense. I don't know how it all plays out. My guess is the majority of the stuff in weak hands has already been sold years ago.
Okay. A question actually for the audience here. I talked about that mine CEO I just met. He's very kindly offered to take me to his mine, which is actually one of the larger silver mines in America. And I, of course, jumped on the opportunity. So I'm going to go. I will bring my recording paraphernalia and try to sort of document it to sort of show you guys kind of how a silver mine operates, and also, you know, get the CEO interviewed a little bit so you can kind of, you know, see more specifically what's in his head about where he thinks the industry is going and stuff like that. If that would be of interest to you all watching, let me know in the live chat if you're watching live, or in the comments if you're watching the replay. Obviously, I like to do more of the stuff you'd like to see and less of the stuff you don't want to see. So if that is something that would interest you, then I'll prioritize hopping on this guy's corporate jet and going to his mine and documenting it all for you.
Okay, if you need a chaperone on the corporate jet to the mine, I'm willing to join you.
Is that something you'd be interested in doing?
Oh yeah, I think I know what you're talking about. I'm not going to guess, but I would love to. You need a chaperone? You let me know. I'll come anytime. Be happy to do so.
All right. Well, that would be really fun if we make it a bro trip to go to the mine together. All right. So I guess just getting back to the title of this live stream, Andy, which is, has the silver boom peaked out? You've already said, you know, from your perspective, no. You think it's probably going a lot higher, though the ride will be volatile. Let me just ask, I'm not going to hold you to this, but just sort of guesstimating, where are you sort of prepared potentially for the silver price to go in 2026?
I mean, let's be pragmatic. And I do have a hard stop in about 7 or 8 minutes.
We'll get you out.
So if we took gold right now at $4,330 and we divided by 42, which is pretty much the average man's price of the last 100 years, you're at what are you at? 43.32 divided by 42. You're at $103. What's interesting is if you take the 45-year cup and handle, the top in 1980 is 45. The bottom is around 4. That's $46 difference. Then you get up to 2011 where it's the top again. So, and then it comes down to the handle. And when it breaks through, you take the top minus the bottom. That's 50 minus 4, 46. Add it to the top. That's $96. Pretty darn close to where that number is. I would not be surprised one bit to see Keith Neumeyer's triple-digit silver prediction years ago play out. And quite frankly, that would just be the average ratio between the two for the last 100+ years. It could go much higher than that. If you realize it's coming out of the ground at 7-1, I'm not saying we're going to get to 7-1, but even take 20-1. Well, 20-1 right now at $4,332 would be $216. Could silver hit $200? Yes. Will it? Don't know. That's a lofty guess, but I think $100 silver is not foolish at all. I mean, at all. Not only is it the average ratio of the last 200 years, roughly 150 years, but it would still be about 6 times higher than it's coming out of the ground at.
Okay. And let me ask you this right now, given market conditions right now, if somebody they had a certain amount of money, $5,000, $10,000, and they wanted to put it in either gold or silver, which would you encourage them to put it in right now?
100% silver. 100%. Okay. Now, if someone had $10 million, it wouldn't be the same thing, because ultimately you want to continue to buy gold. Ultimately, when the music stops, it's about gold, in my opinion. But the value and the leverage and just the flat out, in my mind, best value I've ever seen, most undervalued commodity in the world is still silver. When the music stops, gold's going to be massively reintegrated into the system, and we're not getting any younger. So again, if this is $1,600, whatever, silver, but 90,000 gold, as you get older, moving, schlepping, storing, logistics with silver can become an issue. So I think you use that ratio. Now, when you and I started talking, the ratio was 85-1. Now it's in the 50s. It's averaged roughly 42-1 since the Industrial Revolution. Coming out of the ground at 6-1. You can see this trend disappearing in nature. Only 20% comes from silver miners, the rest byproduct. The trend is for a declining ratio. And then when that ratio gets anywhere 40 or under, you're supposed to switch to gold. So there will come a time to do that. Right now, silver, but could very shortly be gold. But value-wise, for 10 grand, you're just way better off having the leverage of silver versus 2.5 ounces of gold.
Okay. I'm smiling there, Andy, because somebody just put Andy Schectman for president 2028. So just know you got a lot of goodwill amongst the following.
Thank you. I appreciate that, you guys. I try hard. I do the best I can. Hey, saying these things, putting yourself out on a limb in front of the world is not as easy as you might think.
No, and you take a lot of things.
You want to be measured about it, for sure. I don't want to be. One other thing, and I've told you this before too, Adam. When I think it's time to sell, I swear to you, on the Bible, I swear to you that I will tell the world when I think it's time to sell. But I don't think we're anywhere near that yet. But there will come a time to trade your silver to gold, and I'll be the first one to tell you when it's time.
Well, I very much appreciate that. And on that question, Andy, so let's say there's somebody who has amassed a fair amount of physical silver. They're not storing it with you, though. If you're storing it at home, folks, you should store it. I highly recommend consider storing it with an organization like Miles Franklin, just for theft and loss risk. But say they're sitting on thousands of ounces of silver, and we get to the point where you tell folks, hey, you know what? I actually think the wind is now shifted, and you want to put your money more in gold. If somebody says, okay, Andy, I want to convert my several thousand ounces of silver into gold, can they do that through you?
Yeah, we'll make it very easy for them as well. We would help them get it shipped back with FedEx air bills. We would make nothing on the buying of the silver. There's no reason to steal from Peter to pay Paul, whether they bought it from us or not. We'll just make sure that we take all that credit and apply it to the purchase of their gold. So yeah, that's something we're very adept at. We'll help you from start to finish. If it's in a storage facility, it makes it even easier, of course, no mailing and schlepping. But yeah, we'll buy the silver, we'll switch it into the gold. Best if it's in an IRA too, no tax implications. Yeah, I think it's a trade of a generation. And so we will be all over that. I promise you. I've been talking about this since 2000. And you know the old statement that markets can stay irrational longer than people can stay solvent. I am shocked it's lasted this long. But you see it starting to trend back towards its historical mean. And the further you get from historical averages on anything, the greater the magneticism that drifts you back to the mean. It's called regression to the mean. We are regressing. There will come a time where I come on your show and say, now it's time to trade back into gold. And there may come a time down the road where it happens again, where you go back into silver. Anytime you're above 70, you're in silver. Anytime you're below 40, you're definitely in gold, or even 45, you're definitely in gold.
Okay, so if you're younger than 80 years old watching this, sounds like you're saying, Andy, folks, think of this as a game of innings. And, there are going to be some innings where you're going to want to be fielding your gold team. There are going to be some innings where you're going to be fielding your silver team. And part of your job as a long-term precious metals investor here is to kind of know when it makes sense to have which team on the field.
Yes, very much so. Very much so. And speaking of teams on the field, I am going to have to, unfortunately, I'll always stay on these long, but I have
we'll let you go. I know you got
family member golf tournament in my backyard, and I live on a golf course, and they're probably all ready to tee off. But I'm going to come in there not warmed up and whoop them all. So, but I appreciate being here, Adam, more than you know, and I will always be here when you need me. And I'll always shoot from the hip. I want to wish you and everyone else a very, very, very happy, healthy new year. I'm happy to pick up as soon as you want to where we left off. I'm sure there'll be a ton to talk to about over the next couple of weeks. Please don't be bashful. I love doing this, and the live streams are the best form. So something crazy happens over the next few days, I'm willing to jump back on and chat about it.
I so appreciate that. Yeah, I think the odds of something crazy happening are not low. So we'll see what happens there. But importantly, let's let you hop off, Andy. Go beat the pants off the rest of your family. Thanks so much.
I got to do it. And they all leave. They all leave in the next day or two. So I'm gonna get in big trouble by my wife if I'm not on.
Go ahead and invest in the things that matter. Folks watching, stay on for another 60 seconds. I'll do some quick wrap up here. But Andy, thank you so much, my friend.
Take care, brother. I'll talk to you all soon. Thank you. Happy New Year.
All right. So, folks, couple of things. Andy's going to watch the replay. Do me a favor. Just thank him in the replay. Let him know how much you enjoy both him coming to share his insights, but also taking the time again during the holidays to do this for us. Just a reminder, if you want to take advantage of that offer that he is offering to the Thoughtful Money audience, just go to thoughtfulmoney.com/buy gold and fill out the short form there, and you'll, like I said, be in direct touch with Andy and his team there. And do me a favor, if you have enjoyed this live stream with Andy and want to see more of these, just let me know that by hitting the like button, clicking on the subscribe button to this YouTube channel. If you haven't done so already, don't forget to click that little bell icon right next to it so you get alerted of new videos in the future. And again, I read all the comments that get that you all share here in the live chat and in the comment section below. And so if you want to see more of these, if you want to see that mine tour that I mentioned, or if you want to see other things that I haven't mentioned but are on your mind, again, just let me know in the comments and I will read them and take them into consideration. Great way to kick off 2026, folks. Thanks so much for joining us on this Sunday live stream. Have yourself a wonderful new year. And as always, thanks so much for watching us here. Take care, everybody.
If the definition of a dollar is changed and devalued against gold, it is really a devaluation of treasuries, and therefore interest rates are going to skyrocket very shortly after this gold revaluation. And I don't think it will take very long for the end game to hit once this is actually done. We've seen how it affects prices in the past. We know this one is going to be a lot huger than the one that was in 1933 or the indefinite one that was put in place in 1971. This one is going to be monstrous and is going to lead to the end of the treasury market and the end of the US dollar as a fiat currency. And then everything is going to be repriced in terms of gold and silver, of course, when the public realizes it can't get any gold and the only thing that it can get its hands on are perhaps a few ounces of silver, and then we will head into a new era.
An official U.S. gold revaluation, raising reserve valuations to today's market rate, would inject immense book value into the Treasury, 3% of GDP, improved balance sheets, and reduced debt pressure. However, this accounting shift could undermine confidence in the dollar, causing investors to flee into gold, silver, and other non-dollar assets. If the dollar is redefined and devalued against gold, it would essentially devalue U.S. Treasuries and cause interest rates to spike soon after. Past gold revaluations, 1933 and 1971, acted as dramatic tools to address monetary crises, devaluing the dollar sharply and resetting economic expectations. Current parallels are being drawn to the 1971 Nixon shock and potential similar systemic shifts. Investors retreat from the dollar, shifting toward gold, silver, and alternative assets. Rafi Farber, the publisher of The Endgame Investor on Substack, explains that short-term fluctuations remain, with gold prices reacting to data-driven dollar strength. Still, markets anticipate rate easing ahead, which could favor bullion again. Commentators warn that even entertaining the idea of a gold revaluation points to eroding faith in fiat money and public finances. It's seen more as a Rorschach test reflecting systemic anxiety than a mainstream policy plan, but one that signals how close some policymakers are to the edge. The UBMA and COMEX are experiencing record delivery demands as institutions shift to physical gold amid concerns about counterparty risk. Historically, gold revaluations fuel inflation, but a move today could be far more severe, potentially undermining the dollar's fiat status and forcing a systemic reset in gold and silver terms. This comes as de-dollarization accelerates, with gold overtaking the euro as the second largest reserve asset and central banks buying at record level. Watch closely for our professional insight. Click the subscribe button and enable notifications to ensure you don't miss any upcoming material. Thank you so much for your support.
August 1st, some guy who works for the Fed who has a degree in BS economics. I know it's a BS in economics, but what's the difference really? He published an article on the Fed's website about the prospect of gold revaluation in previous gold revaluations that have happened and how they basically had no effect on anything important, except the 3 cases of gold revaluation that he cites are completely insignificant relative to the ones that he does not cite, and those are the one in 1933, which revalued gold 66% higher from 21 to 35, and the devaluation of the dollar in 1971 relative to gold, when the final gold window was finally closed. But he doesn't mention either of these and their effect on inflation, or what he calls inflation, which is the rise in consumer prices. I will show you how gold revaluations severely affect price inflation as defined by the Keynesians with 2 simple charts, and why this gold revaluation, if and when it happens, is going to be at least 60 times worse, because the revaluation will be a mark to market, and even assuming the market price remains at 3,400 whenever this passes, and it won't remain there, the effect of a gold revaluation on the dollar and prices will be extreme, and it will lead to the end game almost certainly. One thing I noticed on Gold Charts R Us. This is a great site that I have a subscription to, and I recommend if you really follow the gold markets, it is very helpful. I looked at the gold future spread because I noticed that there was a record low spread between the 2-month and spot rate, which we'll get to in the next chart. With public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes while also not increasing public debt outstanding. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the US and Belgium recently. For the US, this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which stand around $3,300 per troy ounce. Now it's $3,400. So What would that mean? If you read this article, which I'll put in the link in the description below, it's full of a bunch of crap, which talks about some insignificant gold revaluations in the past few decades, but totally ignores the big one in 1933, 1934 of $21 to $35 a troy ounce, and then the big one in 1971 from $35 per troy ounce or $42 per troy ounce to whatever the market says, which was a gold default. What happened to prices in both of these circumstances? We're going to look at food prices in the immediate aftermath of these revaluations. You'll see it's not good. Here's what Craig Hemke says on the situation. I will link his article in the description below. In the end, Craig says, connecting all the dots for this picture is about as simple as a children's workbook. The politicians are warning you that an official gold evaluation is coming, and the price action since Trump was elected is telling the same story. The only question, what becomes of the market price for gold when this official revaluation happens? And he says, no one knows. Seriously. Well, I do. I just don't know exactly how long it's going to take from the official revaluation to endgame. I don't even know if we're going to make it as far as an official revaluation before the market forces it. But anyway, I'm going to finish this paragraph and then explain why I believe this is so. How could anyone be certain, as no one alive today has lived through the unofficial U.S. government evaluation? Well, I would say that we can still look at the data of an official U.S. government evaluation, and some people who are alive today have lived through it, those who were born in the 1920s and they're centenarians, and they were teenagers when it happened in 1933. Some of them are still alive, and we can find some of them. Anyway, if the U.S. just simply uses a London PM fix of, say, June 15th, 2026, and what does that mean for the gold price on June 16th? Probably nothing. However, it speaks volumes regarding the value of gold as something other than a barbarous relic. Additionally, other central banks and governments around the world may follow suit and issue their own official revaluations. Absolutely. If the U.S. government revalues its gold, of course, the other governments of the world will revalue theirs. And usually we're talking about the central banks here and not the government. But why do I think that the price of gold will head up higher very fast when there is an official gold revaluation mark to market? Well, here is some of the evidence, and then I'll give a logical explanation. First of all, the gold revaluations and inflation below was a 66% revaluation. This one would be 60 times larger than that, because we'd be revaluing gold from $42.22 to about $3,400, which is 60 times larger than the 66% revaluation of 1933. So here you can see these are food prices. I'm going into food prices because I want to know how a gold revaluation was followed. I'm not necessarily going to say affected by directly, but was followed by a huge spurt in food price inflation increases, which means that basic necessities got extremely expensive once the revaluation happened shortly after. You can see here that April 1933, food prices were going down 15.3%. By March 1934, less than 1 year later, food prices were rising at an annual clip of 22.3%. This was only on a 66% revaluation of gold, meaning devaluation of the dollar. Here is the August 1971 gold default. You call it a revaluation, dollar devaluation. It's all the same thing. The August 1971 gold default went from a 3.5% rate in food price inflation in August 1971 to 20%, 19.8% by August 1973. Just about 2 years later, we had the major stagflation of the 1970s, and the only way it was brought down was by the Treasury selling its gold reserves off to try to suppress the price of gold. And now, from a logical, positivist perspective, why would marking gold to market raise the price of physical gold enormously and then lead to huge amounts of food price inflation, which is really the most important part of the Keynesian definition of inflation, because when basic necessities become unaffordable, people start to riot. There are several ways to think of it. The simplest one is this, that gold at the Fed on its balance sheet is not convertible. You cannot go to the Fed with your dollars and get the gold that it has in its basement. What you can do is you can buy gold at a coin shop.
Farber turns to the present and notes that gold has been consolidating for almost 4 months. However, gold miners have already started to appear. In the past, gold has typically followed miners, who set the pace for upward mobility. While gold prices stayed mostly steady, mining equities increased by about 25% in August alone. With miners indicating the next step higher for bullion, that divergence implies the consolidation may be coming to an end. Discovery Alert notes bullish breakouts in miner performance relative to both gold and broader markets. The ratios of GDX gold and GDXJ gold are climbing from multi-year lows, suggesting that mining stocks are attracting capital away from traditional equity allocations, a sign of strategic rotation. Analysts warn that an official gold revaluation could trigger a massive dollar devaluation. This revaluation would be among the most dramatic ever, far outpacing the 1933 and 1971 gold devaluations. Still, experts caution that it amounts to more accounting ingenuity than genuine monetary reform. While it might help with short-term fiscal optics, the underlying risk to inflation, dollar confidence, and debt sustainability would likely remain unless paired with fundamental economic changes. Now, let's shift our attention towards the interview.
195 grams per ton silver at the galleon target, 3.8 grams per ton gold at the horseshoe target. We've got copper, zinc, lead, antimony, gallium, indium, and tin. Rumor has it that Putin will be there soon, and he might take a look at the resources. I don't think he actually will, but it's an interesting coincidence. Now with that, let's go to the charts and an explanation why a gold revaluation would lead to a quick dollar devaluation from an Austrian school positivist logical perspective. For our first chart today, people have been asking me how long is this consolidation in gold going to last, and silver as well. Well, we're at nearly 4 months now, or a little bit past 4 months, about 4 months. We can see here that the candles are the price of the gold miners as represented by the GDX and GDXJ ETFs. We can see here they're both headed higher as of the beginning of August relative to gold, which remains in consolidation. The miners have broken out. When the miners tend to lead gold, that means that gold usually is at the end of its consolidation. Miners usually lead gold in their move. If miners are headed down and gold is not yet, that usually means that gold is headed for a dip. If miners are headed up and gold is not yet, that usually means that miners are leading gold higher. This consolidation is about to end. In my humble estimation, that is. You can see here that miners are up about 25% for the month of August, and gold has been relatively static. Where are we in terms of how nervous the Treasury is getting before there is something bad that happens in the monetary system? Well, it looks like Scott Bessent, our favorite Treasury Secretary, is getting pretty desperate because he's begging the Fed to cut rates 150 basis points. From Bloomberg, U.S. Treasury Secretary Scott Bessent made his most explicit call yet for the Federal Reserve to execute a cycle of interest rate cuts, suggesting the central bank's benchmark ought to be at least 1.5 percentage points, that is 150 basis points, lower than it is now. I think we could go into a series of rate cuts here, starting with a 50 basis point cut in September. That's what he wants. Bessent said in a television interview on Wednesday, if you look at any model, whoa, those models got to be hot. It suggests that we should probably be 150, 175 basis points lower. I wonder what model he's looking at. It costs to lease gold for 2 months. It costs here 3.18%, which is an all-time record high. This was about 2 days ago. And so this is one indicator of gold backwardation. I don't think it's going to stick yet, but if gold is flirting with backwardation because gold now is worth more than gold in the future, which is a backward-dated state. And another word for endgame is permanent gold backwardation. The gold that you can physically hold in your hand is worth $3,400, and that is the premium that people are willing to pay over the gold that you cannot, which is $42.22. Now, if they market to market, that means that gold that you cannot hold in your hand is worth $3,400. Then therefore, what is the premium gold that you can actually own yourself? Well, we don't know exactly what that premium is going to be, but it's going to be a lot higher than $3,400, and it could take a few days or a few weeks or maybe a month to catch up for the premium to start to rise. But recall that the strongest gold rally in history was from 1971 to 1973, which was even stronger in percentage terms than the rally from 1978 to 1980. I know often it doesn't seem that way, it's not thought of that way, but the strongest rally in gold was right after the revaluation or the devaluation of the dollar in 1971. We're going to see something very similar in gold prices if and when there is an official gold revaluation. The other way to think of this in terms of the Misesian regression principle is that all transactions in dollars are based ultimately on promises for gold, because that is how the dollar was born. And because all economic transactions today flow from all economic transactions in the past, it's like thinking about time travel. If you go back in time and change an event in the past, it's going to change all events in the future. So if you change economic events in the past, obviously they will also change economic events in the future. And the economic events of today are still based on the assumption that gold that is owned by the Fed is payable at $42.22 an ounce by dollars, which are the Fed's liability. I understand that people do not actually believe this, but because the economic transactions of today stem from those of yesterday and prices of today stem from prices of yesterday in gold terms, that means if the definition of a dollar is changed and devalued against gold, it is really a devaluation of treasuries, and therefore interest rates are going to skyrocket very shortly after this gold revaluation. And I don't think it will take very long for the end game to hit once this is actually done. We've seen how it affects prices in the past. We know this one is going to be a lot huger than the one that was in 1933 or the indefinite one that was put in place in 1971. This one is going to be monstrous and is going to lead to the end of the treasury market and the end of the US dollar as a fiat currency. And then everything is going to be repriced in terms of gold and silver, of course, when the public realizes it can't get any gold and the only thing that it can get its hands on are perhaps a few ounces of silver, and then we will head into a new era.
The possibility of a revaluation of U.S. gold highlights the financial system's severe structural stresses. Although doing so could momentarily strengthen the government's balance sheet, it runs the risk of inciting inflation, undermining trust in the dollar, and hastening the world's shift toward gold and silver. In addition to reflecting monetary history, the discussion highlights the vulnerability of the current fiat system in the age of de-dollarization, as gold miners have already signaled to the market that they expect bullion prices to rise. Would a revaluation of gold signal the end of the US dollar's position as the nation's reserve currency? Do recent advances by gold miners portend an impending bullion breakout, or are they merely another transient divergence? Post your thoughts in the space provided for comments. Join our community by subscribing to our channel and enabling notifications using the bell symbol if the video resonates with you. We appreciate your participation in our community.
In the bust, most assets are going to go down other than treasuries. But so gold will correct. If 4,000 were the high, and it may not be, could just as easily be 4,500, but if 4,000 is a high, you could be back to 3,000 or below in the bust. People want a target in the bust. I go, we don't even know what the high is on the way up. So, but it'll get hit by, 30% or more probably. Silver, if my target on silver is 75, if we correct from 75, that is more volatile, so that could go down, back into the below 30 or back into the 20s. So they're not going to be straight lines. In both cases, I think this is important. In both cases, in the post-bust era, which is 2027 and beyond, I believe you'll see gold probably in the early 2030s and silver same time frame. Gold to 20,000 and silver to 500. So
the outlook suggests that during a coming bust, nearly all assets except treasuries could fall sharply. If gold peaks around $4,000 to $4,500, it could correct by 30% or more, potentially dropping back near $3,000. But Goldman Sachs says gold could hit $5,000 under scenarios like political threats to Fed independence. Meanwhile, silver, being more volatile, might fall even harder. If it reaches $75, a correction could send it back below $30. These moves won't be in straight lines, but in the long run, especially from 2027 onward, the forecast is extremely bullish. Gold could reach $20,000 and silver around $500 by the early 2030s. David Hunter, a precious metal expert, points out that gold recently broke out of its consolidation range around $3,300 to $3,400, pushing to new highs, with targets now raised to $4,000 and possibly higher. Goldman Sachs warns that gold's price could increase dramatically if the Trump administration's attack on the independence of the U.S. Federal Reserve is successful. They say that would trigger a flight from traditional safe havens, assets people run to when markets get shaky, traditionally, the U.S. dollar. Forecast already predicts gold reaching $3,700 by the end of 2025 and $4,000 by mid-2026. The result of their expectation that central banks will continue their current gold buying spree. On the other hand, silver has been even stronger, up nearly 50% since April compared to gold's 21%. David mentions key drivers include a weaker dollar, falling interest rates, geopolitical tensions, and heavy central bank buying, all reinforced by strong momentum now attracting institutions. The dollar, down from 110 to 97, could drop further toward 82 in steep steps. With the Fed just beginning a rate-cutting cycle that could bring rates near zero over the next 18 months, both gold and silver still have significant room to run despite cautious sentiment in markets. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the article.
Absolutely. And I do say gold was in a consolidation from basically April till recently. And it broke out, from 3,300, 3,400, broke out here, and we're at new highs again. I raised my target to 4,000 last year, or not last year, I think a couple letters ago. I'm not going to be surprised if that proves to be low, more conservative. So I'm very bullish gold here. I'm even more bullish silver. Silver's had a great run. It's up. I just did the numbers yesterday. From April to now, gold is up 21%, I think, and silver's up 49%. So it's quietly, people haven't really noticed, but it's quietly outperforming gold as it does in a bull market. So I think silver has a long ways to go. Gold probably has a good ways to go too. So I think the weaker dollar is certainly part of that story. Lower interest rates is certainly part of that story. Global unrest and global uncertainty is certainly part of that story. And the central banks around the world gobbling up gold is certainly a piece of it too. So, and then the final piece, which people always underestimate, is the power of the momentum. It's all of a sudden the institutions are starting to notice gold, even though it's been running for years. Because it's got that momentum now, they're starting to say, hey, we have to have a piece of gold in our portfolios. Not at all. I mean, the dollar's fallen from, basically 110 to 97 in a matter of a year, probably, or less. And I think it's my target is 82. That's far below here. It'll happen in some pretty steep steps. So the first step down in the mid 90s, and then you consolidated here. I think the next step down takes you down through 90, and then the third step down to 82. So I'm not surprised at all. You have to go through consolidations when you have such a big decline. It then goes the other way for a little while. You have to convince some of the people that were jumping on the bandwagon, but not with conviction, that whoops, this thing's going the other way. So I think we've just pretty much gone through that consolidation, and now we're beginning the next leg down, and I think it could happen pretty fast. Well, think about that. I think that tells you the sentiment that's on the street. Everybody's got including yourself just there, everybody's got a foot out the door saying, when do I exit? right? And so what we've had here, we're just beginning an easing cycle. If the Fed is truly just beginning to cut, and that there's going to be many, many cuts between now and the end of next year, where you could see the Fed fund rate go from 4.25 here down to even zero. They don't know that yet. They have no idea that's what's coming. But if in the next 18 months that's what you're looking at, and you're early on in that, and you're at a point where it doesn't look like the economy's falling out of bed, gold's got a ways to run. Silver's got a ways to run. The stock market's got a ways to run. And yet everybody's getting nervous here rather than bullish.
A few years ago, David called for a major market melt-up and has steadily raised his targets as conditions improved. His S&P 500 target has climbed from 6,000 to 8,700, with Nasdaq at 30,000 and Dow at 60,000. He views this as the tail end of a long bull cycle that began in 1982, likely topping out soon, but still with strong upside left. Despite a slowing economy, falling interest rates and steady earnings are fueling gains. Interestingly, retail investors have stayed confident and bought dips, while institutions were more cautious and even bearish, only now starting to turn more aggressive as they see the market's momentum. Let's look back at the interview.
Probably 3 or 4 years ago, because I was calling for this melt up, and I get accused of raising my targets constantly. I go, that's what you do. As the evidence proves it's got more, there's more things saying it should go higher, you raise your target. So, I started out at 6,000, or even before that at 4,000, but I've raised it to, 7,000 and 7,500, then 8,000, now 8,700 on the S&P. And same thing, I've raised my gold target a few times. But it's the case that this thing is a big historic bull market, and you just gotta stay with it. I'm sorry, I lost my train of thought of what you would. Oh, we were talking about the VIX. Several years ago, I said the VIX could go to 10, and that was when it was in the 20s. And I said if we've got, and that was when I thought the market might go to 4,800, 5,000. I still would say that the low on the VIX, I think, is down just below 10. I think that's probably where we're headed again. So everybody gets worried when it gets down at 14, 15. I go, it can keep going, and there's no magic at 10. If it wants to go lower, it's really, it's a trading vehicle. There are times when it the market goes through a swoon, and it bounces back up over 30 and maybe over 50. But other than that, I don't use it at all to say this is the top in the market, because it can go lower. We are, as I've been saying for a long time, I think we are late in a long cycle, a bull market cycle that started back in 1982. So this is the 43rd year as of August of a bull market cycle that I think is coming to an end. I expect to see, we probably could top out by the end of this year or sooner. But we've got, I raised targets back in April when we had Liberation Day and everybody got bearish. I raised my target to 8,000 on the S&P. From there, in my July investment letter, I raised my target to 8,700 on the S&P, 30,000 on the NASDAQ, 60,000 on the Dow, and the Russell 3,400. So I obviously think there's still a lot to go here, even though I think it's going to happen pretty fast. It is late in the game. We've had a long cycle. The economy is slowing. We may, in fact, already be in recession, but at this point, the evidence is not building to something that says I'm calling for a global bust next year, as you know. But the evidence right now allows most investors to see this as a soft landing, and earnings are still intact. So basically, you've got the best of both worlds: slowing economy, what I think are going to be declining interest rates, and earnings still growing. And that's music to the ears of Wall Street. That will get all the skepticism that's built up on Wall Street. They've fought this this market since 2022, all the way up, you're starting to see them begin to say, "Hey, I gotta get more aggressive because this thing has legs." People, it's not that institutions go all in or all out. They're probably not very much in cash, but they're more defensively positioned. They have been skeptical towards the market. You're right. The retail investor, surprisingly, when we had that swoon back in April, they stayed in the market pretty much, and said this is a buying opportunity. It was the institutions that jumped on the bear market bandwagon and said, "Oh, we're going lower. We're going a lot lower." Strategists across Wall Street were lowering numbers and talking about 4,000 or 3,000 on the S&P. And it was surprising to see the retail investor stay basically on board and bought down there. Like I said, at the very bottom of the sell-off in April, I raised my targets while everybody else was lowering their targets. So, kudos to the retail investor that they this time were the smart money, and it was the institutions that weren't so smart.
Both gold and silver are showing powerful momentum, supported by central bank demand, a weakening dollar, and shifting global policies. While sharp corrections are possible if gold peaks around $4,000 to $4,500 and silver near $75, the long-term outlook remains extremely bullish, with forecasts of historic highs by the early 2030s. At the same time, equities may still have room to climb, even late in the cycle, as falling interest rates and resilient earnings continue to provide fuel. If a sharp correction does occur, would it present a buying opportunity for long-term investors or a warning sign of deeper risks? How much influence will central bank gold buying have in preventing deeper pullbacks in the years ahead? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
What percentage of gold backing the rest of the Fed's balance sheet would make the rest of the treasuries trustworthy to hold for people. And if we go to the 1980 numbers, it's something like $40,000 to $50,000. If we are to equate the dollar value of those 235 million ounces to the rest of the pile on the balance sheet, which is the monetary base, it would have to be 30 to, I think it's about 50,000, or it could be 55,000, somewhere around there, like between 40 and 50 or something like that. It doesn't really make a difference. But that's what we're talking about. I'm not talking about covering M2. I don't think we're going to get there because to cover M2 is what, like 21 trillion, whereas the monetary base is like 5.6 trillion. It had to be 4 times that. I don't think we're going to see $200,000 gold. I think the dollar's going to break before that.
In 1980, the market drove gold higher because investors no longer trusted the Fed's debt-heavy balance sheet. Gold rose enough to fully back that debt, restoring confidence. Applying the same logic today, with the Fed holding about 235 million ounces of gold against a $5.6 trillion monetary base, gold would need to reach roughly $40,000 to $50,000 an ounce. Covering the broader money supply would imply $200,000 gold. Rafi doubts it will reach that point, expecting the dollar to collapse first. Rafi Farber is a financial writer, investor, and commentator often referred to as the endgame investor. He explains that gold is real money, and when its price changes, it's not gold being revalued, it's the dollar. History shows 2 forms of revaluation: statutory, like in 1933 when FDR raised gold's price from $21 to $35, fueling inflation, and market-driven, like in 1980 when distrust in the Fed's balance sheet drove gold up to around $850. Both have the same effect, shifting the value of the dollar, just through different forces. A recent Federal Reserve analysis into gold revaluation mirrors a broader concern over the dollar's stability. While not signaling immediate policy action, it underscores the extent of fiscal stress. These discussions signal deeper doubts about the sustainability of fiat frameworks. Today, stresses in the dollar system are showing up again in the gold futures market, where spreads across maturities resemble those seen in the 2008 and 2020 crises. This suggests another monetary breakdown may be near. While the timeline is uncertain, the underlying truth remains: gold is money, and its role as the ultimate measure of value won't change no matter how the dollar performs. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
What it means that gold is the money. If the gold is the money, then every time the price of gold moves, it's revaluing the dollar. Gold doesn't actually get revalued. The dollar is being revalued. Now the question is, are we talking about statutory revaluation or market-based revaluation? You just cited two examples, one being 1933, which was statutory, right? FDR just decided, maybe on some advisement, maybe on a whim. I remember I read when I was turning libertarian when I was younger, but he was talking about, I think in his book, Broke, how FDR just decided on a whim to make it 35. I don't know, he was just like flipping numbers in his head and he decided that was the one. Could be true, I don't know. And then you were talking about the revaluation in 1980, where the price of gold in the market that you could get a gold coin for to shop was what was being revalued, and that hit 872 or 850, wherever you want to count the top. And ultimately, these are really the same thing. Right? They're brought about in different ways, and that's but they are. Monetarily speaking, what is happening in the monetary system, it's the same thing. It just the difference is who's acting upon it. Like if a 50 kilogram weight drops on your head, you're not going to really care that much if it was, like, say, a meteor from God, or let's say somebody had sinister would drop something on your head from 100 feet above you, or drop the piano on you. Either way, you're dead. It doesn't make a difference. So I don't think we're going to have a statutory gold revaluation. And what happens during a statutory gold revaluation? Well, you look at the price inflation statistics, which we have from the 1930s. And in April 1933, I think the deflationary, and I'm talking about consumer prices, the deflationary statistics were something like -9% a year. And then by about 10 to 12 months after the revaluation from 21 to 35, price inflation shot up to positive 10, 15% or something like that, like a huge move. And really that was the point, because by revaluing, that gave FDR's government, or the Fed under him or beside him or whatever, the ability to print more money based on that gold revaluation, and then the inflation came from there. If there are problems with the dollar, then what you would see is spot gold going pretty high relative to other maturities, but going out into the future I think you would compress in the middle, and then the price would go higher out into the future, because you'd have speculators that are also worried about the dollar, because they're using gold to speculate because they see something wrong with the dollar. But also you have the people at the mouth of the pipe, the big banks, and they are going after spot gold itself. So you're having these like kind of zigzaggy, wavy maturity scheme. And I think that's what's happening now. But you'd have to look at a chart of this. It's available on Gold Charts or Us to see all the maturities and the different colors of the lines, and they get wider as we get closer to a crisis. So the chart goes back to, I think, 2005, 2006. The only time I've seen the maturities be this spread out are 2008, 2020, and now. So the question is it happening again? And there are other signs that corroborate it. How far out are we? I don't think we're very far. People say, like, I've been around since 2020 saying the same stuff, but it's 2025. Even 5 years is not that much time. I know that's kind of a cop-out, but it's also true, and gold is still money. I mean, it doesn't really matter, because I know what the truth is. People can say what they want, but the reality is reality. It's not going to change.
Rafi thinks that the financial system is like a giant pyramid with gold at the base and countless layers of debt and derivatives stacked on top. Nothing can replace this structure. According to BIS, proposals like the stablecoins can boost liquidity and payment efficiency, but they don't fix the financial system's core weaknesses. They only add another fragile layer. Their heavy reliance on U.S. Treasuries exposes markets to volatility, where sudden redemptions could spark liquidity shocks. Even with new rules like the Genius Act, critics argue regulation creates only an illusion of safety while deeper risks remain. Eventually, a crisis will force people holding stablecoins to convert them back into cash, triggering a rush for dollars. At that point, the Fed will have to step in and monetize debt as always, because the underlying pyramid hasn't gone away. These measures may provide short-term liquidity, but in reality, they make the structure even weaker, like stacking jello on top of bricks. One small shock, and the whole thing risks collapse. Now, let's review the interview.
No, it's not going to replace anything. All it's got, we're on a pyramid. The pyramid begins with gold, goes up derivative layer by derivative layer to where we are now. And there's a lot of derivative layers, and you can argue about what layer is which layer and where is it in the pyramid and all this stuff, and it's very complex. But there's no getting out of this pyramid without it either falling over or building a new layer that looks new, but it's really based on everything that's on before. Right? All you can do is build one more layer. So if they do this Genius Act and stable coins, and obviously there are serious threats to personal liberty involved with stable coins, fine. I don't dispute that at all. And I know that the government wants to take as much liberty as they can from us, reasonably, as much as they can reasonably get away with. They tried taking away almost all of it in COVID. There was backlash, and Trump got reelected. I'm really oversimplifying, I know, but I don't have time to get into geopolitics here or anything like that. But what the Stable Coin Act or the Genius Act, whatever they're calling it, can do is it can turn T-bills into a more liquid asset by making them tradable. If people are going to take stable coins as settlement for payment, then it turns T-bills into basically dollars. So the Fed wouldn't have to monetize that debt as quickly, theoretically. But sooner or later there's going to be a crisis anyway, and then everyone with stable coins is going to they're going to need cash, so they're going to have to sell out of their stable coins to get dollars, and there's going to be a rush on dollars, and then Fed's going to have to monetize it anyway because all of this pyramid is still there, and all prices from today are still based on yesterday. No matter what the hell you do, there's no getting out of that ever. Just like there's no breaking the law of gravity, you cannot fly without counteracting gravity with an opposite force pushing down. It's not possible. So at that time when suddenly there's a dollar crunch and everyone has to get out of their stable coins to pay their bills, right? Then the Fed's going to have to take those T-bills, turn them into dollars by buying the T-bills, giving dollars to whoever needs to give dollars to whoever has the stable coins. We're going to be in the same place we are now. So the most this can do is provide a little bit more liquidity on the top of the pyramid. But I guess an analogy would be like instead of like a really heavy brick on the top, right, on the top layer, you'd put, let's say, I don't know, something a little more jiggly, maybe like Jello on the top. So you can build it higher, but it's like a lot weaker, and like a little bit of sun can melt it and then it just falls over anyway. That's the analogy that just came to my head, Jello.
History shows that whenever trust in the dollar erodes, gold steps in as the ultimate anchor of value. Whether through statutory moves like FDR's revaluation or market-driven surges like in 1980, the effect is the same. The dollar weakens, and gold reasserts its role as real money. Today's fragile financial pyramid, propped up by layers of debt and experiments like stablecoins, cannot escape this reality. As stresses build and liquidity games run their course, gold remains the foundation that cannot be replaced, only rediscovered when confidence in paper assets fades. If gold does climb toward $40,000 an ounce, how might this reshape global financial markets and investor behavior? Could stablecoins and digital assets delay a monetary crisis, or do they simply make the eventual collapse sharper? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey,